you are doing everything right. At least that is what it feels like. You have a job, you pay your bills on time, and most importantly, you have money in the bank. Real money. Not credit, not debt, not some abstract number in a retirement account you cannot touch for decades. Actual cash, sitting in an account with your name on it, available whenever you need it. And every time you check that balance, every time you see those digits holding steady or slowly climbing, you feel something that has become increasingly rare in modern life. Safety, security, the quiet confidence that comes from knowing you have a cushion, a buffer, a protection against whatever the world might throw at you. Your parents would be proud. Your grandparents would be prouder. You are responsible. You are careful. You are doing what sensible people do. And you are losing money every single day. Not in a way you can see. Not in a way that shows up on your statement. The number in your account is not shrinking. If anything, it might be growing slightly, adding a few dollars of interest each month, proof that patience and prudence pay off. But that number is a lie. It is a comforting fiction that obscures a slow, silent, invisible catastrophe happening to your wealth. And by the time you understand what has been happening, years will have passed and the damage will be done in ways that cannot be undone. This is not a video about why you should gamble your savings on risky investments. This is not a lecture about how cash is worthless and you should put everything into the stock market immediately. What I am about to show you is more nuanced and more important than that. Because the problem with keeping cash in the bank is not that cash is bad. Cash serves essential functions that nothing else can serve. The problem is that most people have been taught to think about cash in exactly the wrong way by institutions that profit from their confusion. And this misunderstanding is quietly transferring wealth from people who work hard to people who understand how money actually works. Imagine you have $10,000 sitting in a savings account right now, a nice round number, enough to feel meaningful, to feel like you have accomplished something. And let us say your bank pays you 1% interest, which is generous by current standards. At the end of the year, you have $10,100. You made $100 by doing nothing. That feels like a win. But during that same year, something else happened. The prices of everything you buy increased. Groceries cost more, rent cost more, gas cost more, healthcare cost more. This increase has a name, inflation. And in recent years, inflation has been running somewhere between 3 and 7% annually, depending on how you measure it. Let us be conservative and say 3%. At 3% inflation, the things that cost $10,000 at the beginning of the year now cost $10,300 at the end. Your $10,100 can now purchase less than your original $10,000 could have purchased 12 months ago. You made $100 in interest. You lost $300 in purchasing power. Your net position declined by $200, and you never saw it happen because the number in your account went up. This is the cruel mathematics of inflation, and it affects every dollar you hold in cash. Your money is not sitting still. It is decaying, not rapidly, not dramatically, but constantly, invisibly, like rust forming on metal that looks fine from a distance. And just like rust, the damage compounds over time. That $200 you lost in year 1 becomes $400 over 2 years, then $600. Then the losses accelerate as inflation compounds on a base that has already been eroded. In 10 years, at historical average inflation rates, cash that sits idle loses roughly a quarter of its purchasing power. In 20 years, nearly half. You worked for that money. You sacrificed for it. You made choices and trade-offs to accumulate it. And it is evaporating while you watch the wrong number. You trade hours of your life for every dollar you earn. You commute, you stress, you miss time with family. You give your energy to your employer in exchange for compensation. Every dollar in your account represents effort, sacrifice, a piece of your finite life converted into currency. And what does that currency do once it arrives? Nothing. Absolutely nothing. It sits there, inert, while you go back to work to earn more of it. This is the asymmetry that should outrage you. You labour constantly. Your money never labours at all. You're in a partnership where one partner does all the work and the other partner contributes nothing, while slowly becoming worth less. If you had an employee who showed up every day, sat at their desk, produced nothing, and cost you money just by existing, you would fire them immediately. But this is exactly what idle cash does. It occupies space in your financial life, creates an illusion of productivity through its mere presence, and quietly drains value through inflation while contributing nothing to your future. Invested money is different. Invested money works. When you own shares in companies, those companies have employees who show up every day, solve problems, create products, serve customers, and generate profits. Your money is entitled to a share of those profits. When you own bonds, your money is being borrowed by governments or corporations who pay you interest for the privilege. When you own real estate, your money is providing housing that tenants pay to use. In each case, your money is doing something. It is participating in economic activity. It is earning its keep. Cash in a savings account does none of this. It sits in a vault, theoretically available for the bank to lend, and you receive a fraction of a percent for the privilege of letting them use it while inflation takes multiples of that fraction away. But inflation is only part of the story. There is another cost to holding cash that is even larger and even more invisible: opportunity cost. Opportunity cost is what you give up by choosing one option over another. When you keep money in a savings account earning 1%, you are not just losing to inflation, you're also forfeiting what that money could have earned elsewhere. The stock market over any 20-year period in its history has returned somewhere between 7 and 10% annually after inflation. This is not a guarantee about the future, but it is the most reliable pattern in modern financial history. If you had taken that $10,000 and invested it in a simple index fund instead of leaving it in savings, historical averages suggest you would have roughly $25,000 to $30,000 in 10 years. Not from working harder, not from earning more, simply from putting the money somewhere it could grow instead of somewhere it could decay. The difference between $10,000 in a savings account and $30,000 in an investment account is not just $20,000. It is the future that $20,000 could have funded. It is years of retirement. It is options when you need them. It is the gap between working because you choose to and working because you have to. And this gap widens every year you wait, because the money you invest today has more time to compound than the money you invest tomorrow. The cost of keeping cash is not just what you lose, it is everything you never earn. Now, I can already hear the objection forming in your mind because it is the same objection everyone has. But what about emergencies? What about unexpected expenses? What about the security of knowing the money is there when I need it? And this objection is valid. It is important. It is the reason that emergency funds exist and the reason that some cash is genuinely necessary. But here is where most people go wrong. They confuse emergency funds with fear money. An emergency fund has a specific purpose and a specific size. It exists to cover genuine emergencies, job loss, medical crises, urgent repairs, the unexpected events that would otherwise force you into debt or financial catastrophe. Financial experts generally recommend somewhere between 3 and 6 months of essential expenses, depending on the stability of your income and your personal risk tolerance. 3 months if you have stable employment and multiple income sources. 6 months if your income is variable or your industry is volatile. This money should be liquid, accessible, and yes, sitting in a boring savings account where you can reach it immediately if disaster strikes. But most people with significant cash savings have far more than 6 months of expenses. They have 12 months, 18 months, sometimes years of expenses sitting in accounts earning almost nothing, protected against emergencies that would never require that much liquidity. And when you ask them why, when you really press on the reasoning, the answer is almost never mathematical. The answer is emotional. The answer is fear. Fear of the market crashing, fear of losing money, fear of the unknown, the unpredictable, the uncontrollable, and this fear is understandable. It is human. The stock market does crash sometimes. Investments do lose value. There is genuine risk in putting money into anything other than a guaranteed account. But fear disguised as prudence is still fear, and fear-based financial decisions are almost always wealth-destroying financial decisions. The person who keeps 2 years of expenses in cash because they are afraid of the market is not being cautious. They are paying an enormous premium in lost returns and inflation erosion for the emotional comfort of seeing a stable number, and that premium compounds every single year they pay it. Here is a question worth asking yourself. How much cash do you actually need for emergencies? Not how much makes you feel safe. How much could you actually need? Walk through the scenarios. Job loss. How long would it realistically take you to find new employment? What are your actual monthly necessities? Not your current spending, but the stripped down essentials you would need to survive while searching. Medical emergency. What is your out-of-pocket maximum? What expenses would you actually face that insurance would not cover? Home or car repair? What is the most expensive plausible repair, And do you have other ways to cover it if necessary? Your health insurance has an out-of-pocket maximum. In America, for most plans, this is somewhere between $3,000 and $8,000 for an individual, perhaps double for a family. This is the absolute most you would pay in a year for covered medical expenses, no matter how catastrophic. Your car, even with a major repair, rarely exceeds $3,000 to $5,000 unless it is totaled, in which case insurance covers replacement. Your home might need a new roof, a major expense, but one that can often be financed or paid over time. Job loss is the big one, the scenario that justifies the largest emergency fund. But even here, the math is more modest than fear suggests. If you lost your job tomorrow, what would you actually need each month? Not your current spending, your survival spending, rent or mortgage, utilities, food, insurance, transportation to job interviews. For most people, this stripped-down number is significantly less than their normal monthly expenses, often 50 to 70% of their regular spending. If your normal expenses are $5,000 a month, your emergency expenses might be $3,000. 6 months of emergency expenses is $18,000, not $30,000. And that assumes you find no income at all for 6 months, no unemployment benefits, no severance, no freelance work, no part-time job to bridge the gap. The realistic emergency need is almost always smaller than the fearful emergency hoard. When you do this math honestly, most people discover that their true emergency needs are far smaller than the cash they are hoarding. The excess, the money beyond what emergencies could plausibly require, has no job. It is not protecting you. It is not serving any defined purpose. It is simply sitting there, decaying, because moving it feels scary even though keeping it is objectively more costly. And here is something that makes this even more complicated. Visible cash changes behavior. When you see a large balance in your checking account, your brain interprets that as available money. Money you could spend. Money that is not committed to anything. And this interpretation, whether you act on it or not, creates psychological permission to spend more freely than you otherwise would. Studies consistently show that people with larger visible balances spend more than people whose money is allocated elsewhere, even when their total financial positions are identical. The cash is not just failing to grow, it is actively encouraging the behaviors that prevent wealth accumulation. The solution for most people is to reduce the visibility of money that should not be spent. Move your emergency fund to a separate account that you do not check regularly. Automate transfers to investment accounts so the money leaves before you see it. Create a structure where the default is investment and the exception is spending, rather than the other way around. This is not about willpower. Willpower is unreliable. It fails when you are tired, stressed, or tempted. Systems do not fail. Systems execute regardless of how you feel. And the system that moves money automatically, before it can be seen as available, will outperform the discipline that tries to resist spending money that is sitting visibly in your account. But let me address another assumption that keeps people locked in cash. The belief that bank accounts are completely safe. They are not. They are safer than most alternatives, certainly. In America, the FDIC insures deposits up to $250,000 per depositor per institution. This means that if your bank fails, the government guarantees you will get your money back up to that limit. This is meaningful protection. It is why bank runs are rare, and why most people never worry about the solvency of their bank. But notice the limit, $250,000. If you have more than that in a single institution, the excess is not protected. You could lose it. This is unlikely, historically rare, but possible. And more importantly, this protection only covers the nominal value of your deposit, not its purchasing power. The FDIC guarantees that if you deposit $250,000, you will get $250,000 back. It does not guarantee that those dollars will buy the same amount of goods and services. Inflation is not insured against. The decay is not protected. You're guaranteed to get your number back, but that number will purchase less every year you hold it. And there is another risk that most people never consider. Liquidity attracts predators. Large cash balances make you a target for scams, manipulation, and financial deception of every variety. The email phishing attempts, the phone calls from fake IRS agents, the investment opportunities that seem too good to be true because they are not true at all. Scammers do not target people who have no money. They target people who have accessible money, money that can be transferred quickly, money that is not locked up in assets that take time to liquidate. You might think you're too smart to be scammed. Everyone thinks that. The victims of financial fraud are not stupid people. They include doctors, lawyers, executives, people with advanced degrees and sophisticated understanding of the world. Confidence in your own judgment is actually a risk factor, because it prevents you from seeing the manipulation until it is too late. Large cash balances combined with overconfidence is one of the most dangerous financial combinations possible, not because the money will be stolen by your bank, but because it makes you a more attractive and more vulnerable target for people who are professionally good at separating others from their money. So if keeping too much cash is a problem, what is the solution? The solution is not to panic. The solution is not to move all your money immediately into something you do not understand. The solution is to give every dollar a job, and to make sure that job matches the dollar's time horizon. Here is what I mean. Money you need in the next year should be in cash or cash equivalents. This is your emergency fund, your upcoming planned expenses, your short-term needs. This money should be liquid, accessible, and stable. Yes, it will lose value to inflation. But the purpose of this money is not growth. The purpose is availability. You're paying the inflation cost for the benefit of immediate access, and that is a reasonable trade for money you might actually need soon. Money you need in 1 to 5 years could be in slightly higher yielding vehicles, high-yield savings accounts, certificates of deposit, short-term bonds. The returns will be modest, barely keeping pace with inflation, but the stability is appropriate for medium-term goals, a down payment you're saving for, a major purchase you're planning, money that has a specific destination within a defined time frame. Money you do not need for 5 years or more should almost certainly not be in cash. This is money that has time to ride out volatility, time to compound, time to recover from temporary downturns. This money belongs in diversified investments, index funds, assets that have historically grown far faster than inflation over long periods. Yes, this money will fluctuate. Yes, you will see red numbers sometimes. Yes, there will be periods where it feels like you made a mistake. But the person who keeps long-term money in cash to avoid seeing red numbers is not avoiding loss. They are guaranteeing loss slowly, invisibly, in a way that never shows up on any statement but is absolutely real. The fear of short-term volatility is one of the most expensive emotions in personal finance. Markets go up and markets go down. This is normal. This is expected. This is the price of admission for long-term growth. The person who pulls out of the market when it drops locks in their losses and misses the recovery. The person who never enters the market because they fear drops never participates in the growth. Both are making emotional decisions that feel protective, but are actually destructive. The market has recovered from every crash in history. Cash has never recovered from inflation. And I want to be specific about this, because vague reassurances do not overcome visceral fear. Let me tell you what history actually shows. In 1987, the stock market crashed at 22% in a single day. Black Monday. People who sold in panic locked in those losses permanently. People who held saw their portfolios recover within 2 years and go on to multiply many times over the following decades. In 2000, the dot-com bubble burst and the market fell nearly 50% over 2.5 years. People who fled to cash missed one of the longest bull markets in history that followed. In 2008, the financial crisis sent markets down 57% from peak to trough. The recovery took about 5 years, and then the market more than tripled over the next decade. In 2020, the pandemic crashed markets 34% in just over a month. The recovery took less than 6 months. Every single time, the pattern is the same. Crash, fear, recovery, new highs. Every single time, the people who stayed invested came out ahead of the people who fled to cash. Every single time, the volatility that felt unbearable in the moment became a footnote in a longer story of growth. Cash does not have this pattern. Cash does not crash and recover. Cash just slowly, steadily, permanently loses purchasing power. This safety you feel holding cash is the safety of a slow leak versus a sudden drop, but the slow leak never reverses. The drops always do. And this brings us to the fundamental principle that should govern where every dollar lives. Money should have a purpose. Undefined money, money that is just sitting there without a clear job, is money that will decay. Not because you did anything wrong, but because that is what idle cash does. It loses purchasing power, it accumulates opportunity cost, it attracts spending impulses and fraud attempts. It creates a false sense of security, that prevents the actions that would create real security. Think of your money as employees in a company. Every employee should have a role, a function, a reason for being on payroll. The emergency fund employees are your security team, standing ready for crises that may never come but must be prepared for. The short-term savings employees are your project managers, working towards specific goals with defined timelines. The invested money employees are your growth team, out in the world generating returns, expanding your wealth, building your future. What you should not have is a large group of employees sitting in the break room, doing nothing, costing you money every day in lost productivity, while creating the illusion of a robust workforce. That is what excess cash is. It looks like an asset on your balance sheet, but it functions as a liability, slowly draining your wealth through inflation and opportunity cost while providing nothing in return. So here is what I want you to do. Look at your cash, all of it. The checking account, the savings account, the money market fund, whatever vehicles are holding your liquid assets, and ask yourself, what is the job of each dollar here? Is this emergency money? If so, how much emergency money do you actually need? Based on math rather than fear, is this short-term money earmarked for a specific goal within the next few years? Is this long-term money that somehow ended up in a short-term vehicle and is now quietly losing a race it should not even be running? For most people who do this exercise honestly, the answer is uncomfortable. There is too much cash. There is too much money with no defined purpose, sitting in decay mode, slowly transferring wealth to inflation and opportunity cost. And the path forward is not dramatic action. It is intentional allocation. Moving the excess, gradually if necessary, into vehicles appropriate for its actual time horizon. Giving every dollar a job so that every dollar can work instead of rot. This is not about being aggressive. This is not about taking risks you do not understand. This is about matching your money to your goals, your time horizons, your actual needs rather than your fears. The person with a properly sized emergency fund and appropriately invested long-term savings is not taking more risk than the person with everything in cash. They are taking less risk because they are protecting against the guaranteed loss of inflation rather than the possible loss of market volatility. The bank wants your deposits. They lend your money to others at higher rates than they pay you, and they keep the difference. This is how banks make money. There is nothing wrong with this, but you should understand it. When you keep excessive cash in the bank, you are subsidizing their business model at the expense of your own wealth. You're choosing the certainty of slow decay over the probability of long-term growth. You're paying for the comfort of a stable number, while the purchasing power behind that number erodes. Your money is capable of working as hard as you do. It is capable of compounding, growing, multiplying while you sleep. But it cannot do any of this while sitting in an account designed for liquidity rather than growth. Every day it sits there is a day it could have been growing. Every month is a month of compounding lost. Every year widens the gap between where you are and where you could have been. The number in your bank account feels like safety. It looks like responsibility. It seems like the right thing to do. But money does not care about feelings. Money follows rules, and the rules say that idle cash loses purchasing power, that invested money tends to grow over time, and that the difference between these two paths compounds into life-changing amounts over the decades. You have worked too hard to let your money sit idle. You have sacrificed too much to watch it decay in an account that feels safe but is not. The safety you feel is an illusion purchased at enormous cost, and the cost grows every day you do not see it. Give your money a job, match it to your time horizon, keep what you need for true emergencies and stop hoarding what you do not need out of fear. Let the rest work for you the way you have worked for it.